Hi, this is Gautam. In today's class, it is going to share us some subject about accounting for cost and management. In that, the topic is classification of ratios. What are the ratios? So let us see. The ratio is nothing but a simple arithmetical expression of the relationship of one number to another. It may be ratios, for example, like that 2:1 or 1:1 like that. So this should be the relationship between one number and another number. Should be like that. So here, how the ratios should be classified according to in this criteria. Here, the first one is balance sheet ratio. We know the balance sheet. What are the things has been covered in balance sheet? Here, the first one is current ratio. Then second one is liquid ratio. Third one is absolute ratio. And then fourth one is proprietary ratio. Then fifth one is debt equity ratio. The last one is capital gearing ratio. So these are the things. Mostly these are the things as covered under the balance sheet ratio. What is the current ratio? So what is the current ratio? Current ratio is nothing but should be relationship between current assets and current liabilities. So what are the current assets? Here the current assets should be easily converted into cash, either by cash like that, cash in hand, cash at bank, bills receivable, maybe stock. So these are the things have been covered under current assets. The second one is liquid ratio. What do you mean liquid ratio? The liquid ratio means it should be fulfilling the short-term obligations, maybe for the period of 1 to 3 years like that. So it should be easily, quickly converted into cash. The third one is absolute ratio. What do you mean absolute ratio means? It should be includes like cash, bank, and then marketable securities which should be keep for loan process like that. The fourth one is proprietary ratio. The last one is proprietary ratio is nothing but it should be concluding with the total asset value. It should be concluding with the total asset value. That is called proprietary ratio. The next one is debt equity ratio. What is the debt equity ratio means? It should be measured as debt financing has been used for business. It should be we exactly don't know what are the things, what are the amount, what are the investment level we are going to invest in business. It should be approximately more than lakhs or more than thousands like that. Then last one is capital gearing ratio. So capital gearing ratio is nothing but it should be describe the relationship between equity share capital include reserves and surplus to preferential capital and other fixed assets like that loans like that. So preferential and as well as something else. So these are the things have been covered under balance sheet ratio. The second one is profit and loss ratio. So what are the things have been covered with this profit and ratio? These things should be mandatory to find out the profit of the company. The first one is gross profit. The second one is net profit. And third one is operating ratio. The last one is expenses. So this one is gross profit. So gross profit is the main thing. With the help of this gross profit only, we know the levels of the company profit level. The second one is net profit. Net profit means that should be nothing but all the expenses and as well as all the incomes should be concluded in this net profit. The last one is operating ratio. Here, operating ratio is nothing but should be operating expenses like we have discussed earlier, like office expense, selling expense, traveling expense, advertisement, so many things, postage like that. So in this, we are covering about the operating expenses, and the last one is expense ratio. So all the expenses should be covered in this. The last step is last classification is finally stock turnover ratio. Stock here there are two types of stock is there. One is opening stock and another one is closing stock. So at the time of opening stock, the opening stock should be totally different from closing stock. The second one is debtors turnover ratio. Here the debtors turnover ratio is nothing but should be sundry debtors like that. So the third one is creditors turnover ratio. Creditors is nothing but one who gives the loans, one who gives the money to you for furtherance of doing business like that. The third and then fourth one is fixed asset ratio. Fixed asset is nothing but here that should be fixed one like land, building, machineries, etc. There should be fixed amount of levels that should be covered with this fixed asset ratio. The last one is capital turnover ratio. Capital is the main what are main source for the company. With this help of investment of capital, we know the levels of maintaining a profit and as well as things that should be happening in the company. These are the things able to classification of ratios. So ratios is nothing but should be numerical numbers. It should be differentiated between one to another. For example, 2:1, 1:1 like this. Should be according to this basis of